Okay, good morning everyone. For those that don't know me, my name is Simon Bottoms and I'm the Mineral Resource Management and Evaluation Executive for Barrick. Part of my role, I'm responsible for all technical studies across the Barrick Group, from preliminary economic assessments through to feasibility studies. And more importantly, ensuring that we stick to our strategy through all aspects of our everyday business. Accordingly, I'm also the lead qualified person signing off the Barrick Group resources and reserves. So firstly, looking to our strategic filters that provide the key framework to guide our investments and capital allocation in our everyday operations. The first of our strategic filters is that we only invest in ore bodies where the primary revenue is generated from gold or copper mineralization, albeit we acknowledge that some will come with other byproduct credits. With specific regards to our asset quality filters, we have clearly defined criteria for Tier 1 assets, for which gold projects need to have the potential to produce more than 500,000 ounces per annum for at least 10 years, and copper projects need to have the potential for reserves of more than 5 million tonnes of contained copper, both of which require life of mine costs to be in the lower half of the industry cost curve. For Tier 1 assets and investments, we look for a return of 15%. But for long-life copper and gold assets with more than a 20-year life, we reduce this return on investment requirement to 10%, reflecting the increased levels of returns provided by exposure to multiple commodity cycles post-return of initial capital investment. We always use input cost models to set our reserve prices. In the current high gold price environment, using our reserve prices provides us with opportunities for increased margins to support reinvestment in the growth of the business, whilst also providing returns to host countries and shareholders. As mentioned by Mark at our recent quarterly, we will be lifting the 2024 gold mineral reserve price to $1,400 an ounce for all Tier 1 assets, reflecting the inflation of key input costs, with some exceptions, notably for non-core and non-operated assets. Our copper reserve prices remain unchanged at $3 a pound for 2024, which is directly linked to the imminent completion of the ongoing feasibility studies at both Lumwana and Reko Diq, both of which are on track to meet our Tier 1 criteria with the completion of these feasibility studies. As you may have heard us mention previously, many of the Barrick Tier 1 gold mineral reserves are geologically constrained. This means the existing mine designs already optimally extract the entire ore body. To illustrate this point, the cross-sections on this slide are from two of our Tier 1 assets at Kibali and Turquoise Ridge. The red stope-shape outlines are at $1,400 an ounce, and the blue stope-shape outlines are at $2,500 an ounce. The blue stope-shape outlines on this slide add approximately 10% more ounces of marginal sub 1.5 gram a tonne peripheral mineralization, but also add 40% more tonnes, resulting in 20% lower mine grades. As illustrated in these images, the red $1,400 an ounce stope outline already effectively extracts the entirety of the geologically defined ore body, which in essence extracts the highest amount of value and is reflective of the quality of what we call Tier 1 assets. Within our open pit operations, increased commodity prices can always be used to incorporate additional pushbacks, but these will inevitably come at higher strip ratios. To ensure that we preserve the long-term optionality of bringing additional pushbacks into our mine plans in the future, we use our mineral resource prices to position key capital infrastructure, such as process plants and tailings dams. Accordingly, at the end of 2024, we're also planning on lifting our gold mineral resource prices to $1,900 an ounce, whilst again maintaining our copper mineral resource prices at $4 a pound. Overall, this approach is complemented by our reserve replacement strategy, where we aim to add value by delineating ore body extensions and satellites at our long-term reserve prices, rather than diluting the quality of our reserves and mine plans through lifting reserve prices beyond the relative levels of inflation. A commonly overlooked but critical aspect of our strategic investment filters that differentiates the quality of what we as Barrick call Tier 1 is the fact that we look for deposits to be located in world-class districts with the potential for organic reserve growth. Kibali is a perfect example of this, whereby we initially purchased the project in 2009 with a mineral reserve base of 5.5 million ounces. But after logging more than 20 kilometers of core, it was evident that the KCD underground ore body contained at least 10 million ounces. Fast forward to the present day, and our ongoing reserve replacement strategy has grown reserves over and above depletion consistently for the last 5 years, resulting in more than 10 million ounces in remaining reserves, despite pouring over 7.7 million ounces of gold to date. Ongoing resource conversion drilling is again on track to continue this depletion replacement track record at Kibali this year. And as shown on the slide, we are investing in exploration drives for future conversion, which will later be reused for mine haulage and ventilation. The results of our peerless focus on organic reserve growth are demonstrated by our delivery of some 32 million ounces of attributable gold equivalent reserves since 2019 for an all-in cost of $23 an ounce. On a 100% basis, this represents nearly 44 million ounces added across our asset reserve base. This track record is a clear illustration of what we term to be Tier 1 assets as part of our strategic filters. It is important to note that this organic reserve growth within our portfolio has been delivered through extensions to our existing mines, thereby truly leveraging our already installed capital base. This slide illustrates the comparison of the results of our strategy relative to recent industry M&A transactions on a dollar per ounce basis. And as can be seen clearly here, the return on investment delivered by the Barrick strategy is exponentially higher than all other recent M&A transactions. Then, when you consider our expected year-end 2024 position, we forecast to include another year of successful depletion replacement, combined with the completion of both Reko Diq and Lumwana feasibility studies. This places the gold equivalent ounces on par with the largest scale M&A transactions in the industry, for approximately 2.5% of the industry average cost of reserve acquisition through M&A. Turning now to our value foundation in Nevada. When we first completed the NGM merger, Barrick had been high-grading their ore bodies for a number of years, the result of which was significant underinvestment in the geological understanding that underpinned our resource estimates. As a result of this, we have been focused on building our geological foundations back into our ore body models. And as you can see from the cross-sections on this slide, in the Turquoise Ridge example, this improved geological resolution drives substantial changes to the resulting resource estimates. Historical mining areas within the high-grade cores of the ore body are still consistent in both models. The continuity of the mineralization, hosted in what we term to be the basal sloped facies, that now sustains many of our mining areas today, has dramatically improved in resolution. During the last 2 years, we have been sequentially drill testing these updated interpretations and building our detailed grade control drilling coverage, both of which were substantially neglected prior to the NGM merger. As mentioned by Ari earlier, this improved geological resolution has provided us with the foundation to re-optimize our mine plans across the whole of Nevada, both in open pit and underground. This re-optimization and associated reinvestment in our operational flexibility has delivered a 20-year mining profile, built on robust, geologically supported resource models. By leveraging this geological understanding, we've been able to add in excess of 19 million ounces on a 100% basis to the life of mine plan since the formation of the JV. And today, this still excludes both the additional exploration upside that we still see and the world-class 4 Mile asset that I will talk to you more about later in this presentation. I truly believe that this positions us to continue to sustain Nevada's Nevada as our value foundation for future generations to come. A prime example of another asset where we have drastically overhauled the geological understanding that underpins the resource model is at Bulyanhulu in Tanzania. Previous operators substantially overstated the annual production profiles by trying to develop the mine infrastructure without the requisite geological understanding. Since we took operatorship, we have successfully defined and delivered a plus 200,000 ounce per annum production profile that extends out beyond 2040. We have recently turned to investment in new mine infrastructure to generate production flexibility, including 2 surface box cuts, which allow us to mine from shallower areas whilst ramping up both development and stoping in the deep areas of the mine. Added to that, as mentioned by Seb earlier, next year we are commencing a feasibility study to evaluate the option of equipping new vent raises for hoisting, which could potentially increase annual production profiles between 20 and 30%. And in turn, this could reduce the overall operating cost as we fully utilize the installed capacity of the processing plant. As mentioned by Seb earlier, Lumwana is another core example of where leveraging our ore body knowledge and debottlenecking the existing infrastructure unlocks this world-class resource base and enables us to reposition Lumwana as a long-life, high-yielding copper producer capable of withstanding the volatility in inherent copper demand cycles. The expansion is driven by 2 key elements. Firstly, the doubling of the throughput by twinning the existing process circuit, effectively increasing the average annual copper production from the current 120 to 140,000 tonne range to a life of mine average of 240,000 tonnes per annum. All of the design parameters that we've used for this process expansion are not only linked back to test work, but also draw directly from existing operational data, ensuring a robust, high-confidence design. The second key component of the expansion is the ramp-up of total mining volumes. These are expected to increase incrementally year on year from 150 million tonnes this year to approximately 290 million tonnes in 2029, and then to an average run rate of 300 million tonnes from 2030 for the subsequent 10 years. Throughout the course of this ramp-up, we will increase the current ultra-class trucking fleet to a total of 10 ultra-class shovels and 70 ultra-class trucks by 2030. The expansion plan is currently projected to consist of some 8.3 million tonnes of contained copper at an average grade of 0.53%, which we expect to form part of our year-end mineral reserve update with the conclusion of the feasibility study. The Lumwana expansion layout design is a prime example of how our core values drive our mine optimization process. As you can see on the layout map, the TSF expansion immediately abuts the western wall of the current TSF, and all waste rock dumps are positioned over already disturbed areas, thereby minimizing the impact on our environment and communities. The Kamisengo conveying infrastructure is scheduled to be constructed in 2037, allowing mining to commence in 2039, which will sustain the process plant feed during the stripping phases of the deeper pushbacks within the Chimiwungo Super Pit from 2040 onwards. At this time, the overall mining rate will step up to 340 million tonnes, as the satellite pit provides a distinctly separate mining area to support an independent fleet. As I indicated earlier, all long-term infrastructure, such as the process plant, TSF, and water storage facilities, are normally positioned outside of our resource pit shells. But in the case of both Lumwana and Reko Diq, due to the extended mine lives, we have positioned all key infrastructure outside of the $5 per pound pit shells, preserving the optionality for further expansions and pushbacks after 2056. The profitability of this expansion is secured by making tangible changes in the mine infrastructure. One such example of this is the utilization of a new pit rim crusher and conveyor in the Chimiwungo pit from 2028 onwards, which cuts our current ultra-class trucking haul cycles by at least 15%. And then, from 2034 onwards, we plan to incorporate in-pit crushing and conveying within the Chimiwungo Super Pit, again providing continuity of the trucking requirements as the pit continues to get incrementally deeper. The expanded process circuit will introduce a high level of automation through proven advanced process control systems. Once this new circuit is fully commissioned and producing copper, the existing plant will be taken offline to install these same upgrades into the existing process stream, which when fully ramped up will enable us to deliver an overall reduction in costs by providing a substantial increase in productivity per man hour and lowering overall reagent consumptions. More details on the Lumwana expansion are available in our Lumwana Super Pit expansion update on our website. We now turn to Barrick's 100% owned, world-class 4 Mile project, which deserves a section of this presentation unto itself. As you may have seen in our press release this morning, the results of the ongoing drilling in 4 Mile, for which Mark showed you a number of the results in our recent Q3 presentation, have defined an updated mineral resource in the southernmost portion of the 4 Mile ore body, immediately abutting Goldrush. This updated resource is a result of 25 new drill holes at a spacing of at least 90 meters across the highlighted area, resulting in 187% growth in indicated resources and 138% growth in inferred, both with notable increases in grade. This initial mineral resource only covers approximately 1/3 of the overall ore body as we have defined by drilling to date. As the ongoing resource conversion drilling progresses incrementally to the north, the ore body grades continue to increase as a result of the silicified breccias from Rose Stem through to Dorothy. This truly world-class 4 Mile ore body can only really be compared to the Goldstrike underground mine, which to date has produced some 12.7 million ounces of gold with head grades of more than 10 grams a tonne, and still has remaining resources of more than 4 million ounces. Looking at all the drilling results to date, I see absolutely no reason why 4 Mile will not become a new benchmark in the history of Nevada gold mines, for both grade and size. Before I show you the potential value that this can generate, I would like to show you a short video to illustrate the size and continuity of the ore body as we know it to date, with a snapshot of the access infrastructure that we are currently planning. Firstly, as you can see, the 4 Mile permit covers the substantial topographic high between 2 canyons, underneath which the ore body is located. The northern exploration access that we plan to develop is located at Bullion Hill, where the portal is situated approximately 800 meters below the ridgeline. The decline from this will provide a continuous 4-kilometer long access that extends over the top of the 4 Mile ore body and ultimately connects with the Goldrush multi-purpose development and provides further platforms for drilling. Geotechnical drilling has shown that the majority of the decline will be located within highly competent non-permeable rock units in and immediately adjacent to the Mill Canyon stock, meaning that only localized water seepage management is required during underground access development. We believe this development will also provide a number of long-term benefits to the immediately adjacent Goldrush mine, including potential for increased levels of production. As I have mentioned, the updated mineral resource only covers approximately 1/3 of the overall ore body, which still remains open today, with further step-out drilling currently underway. To illustrate the potential value that a truly world-class ore body like 4 Mile has, we've completed an updated preliminary economic assessment using criteria and costs which draw directly from the Goldrush mine plan. These operating costs provide an ultra-conservative benchmark due to the clear geotechnical indications that the silicified breccias within 4 Mile will support a much higher tonnage and lower cost underground stoping profile than ever seen in Nevada before. Despite these very conservative parameters, the embedded value of the project is abundantly clear, achieving potential Tier 1 production and costs at very low annual mining rates. Even when using these very conservative parameters, the annual operating cash flows resulting from 4 Mile are expected to be more than 70% higher than the already world-class Goldrush project, purely as a result of the ore body grades. The main components of the project capital costs are currently forecast to consist of the underground mine development, including dual vent raises, upgrades to electrical reticulation, and construction of a new paste backfill plant. Initial metallurgical test work has indicated that the highly silicified competent breccias are potentially single refractory, and thus they may be able to make use of existing autoclave capacity, which will only defer low-grade 2 gram a tonne stockpiles from the current mine plan, yielding the potential to add significant incremental production. The upper subhorizontal cavity breccias are thought to be more analogous to that of the mineralization in Goldrush, in terms of both ore body geometry, which ultimately defines the mining stope sizes, and in their contained carbon content, which results in the requirement for them being fed to the roasters. From 2025 onwards, we plan to commence a 3-year pre-feasibility study, which will continue to define substantial resources and ultimately reserves across the entire ore body from surface, whilst also permitting and developing the Northern Bullion Hill access, linking up with the Goldrush multi-purpose development, and completing pilot-scale autoclave and roaster test work. Turning now to Carlin, the 14 million ounce Leeville complex is another example of a geological frontier that has been completely revived since the Nevada Gold Mines joint venture. We plan to deliver the next phase of growth, which could more than double the size of the existing Leeville complex, by undertaking several campaigns of step-out drilling along these emerging corridors to evaluate the continuity of economic mineralization in support of new potential surface access points. Drill results to date have consistently returned results supporting the concept that these Leeville operations will continue to deliver some of the largest growth operations outside of our existing mine plans, which underpin the future of Carlin Complex, amongst the world-class giants of TR and Cortez districts. To date, both Leeville and Wren have been significant contributors to our growth in Carlin, and we expect to continue to see this trend in our year-end reserve updates later this year. Now, taking a step back to look at our 10-year production profile, which reflects the overall results of the mine plan updates that my colleagues and I have highlighted to you today. The majority of this profile is driven by a true Tier 1 portfolio with high-quality reserve and resource foundations and geologically constrained mine designs, which provides a true reflection of the quality of our assets. This profile maintains our outlook of growing attributable production to more than 6.5 million ounces of gold equivalent by the end of the decade, and continues to sustain production at and around this level thereafter as a result of the imminent development of the Reko Diq and Lumwana projects. As you can see, these world-class projects deliver significant growth in both our copper and gold profiles, without the need for expensive M&A, or diluting our existing shareholder base. We are confident that we can continue to grow this profile organically as we bring 4 Mile into the Nevada Gold Mines joint venture profile, evaluate the potential of Greater Leeville, and incorporate the handsome production potential into Cortez Underground. We believe this truly sets us apart from our peers within the industry as we continue to find, develop the best assets with the best people to deliver sustainable returns for all of our stakeholders.